Hi guys, it's a beautiful sunny Sunday morning in beautiful Parramatta Park in Cairns, and I've decided to finally do a video on my investing. I hope it doesn't put you guys to sleep, but I'm hoping it also provides you with a bit of advice on investing in the stock market. I've learned a hell of a lot participating in that particular market over the last 18 months or so, and I've made a fair few big mistakes, and I've had a few wins along the way. So it's been a bit of a mixed bag, and I'll give you an honest appraisal from my perspective. I know very little about it. My knowledge base is very short term, as I've just mentioned, but what I tell you is what actually has happened to me, and it's not all good, so you know I'm not BSing you. But bottom line is, I think it is good to have some shares, because they can certainly outperform the returns you get on depositing money these days. And I'd be a bit wary about putting money into real estate. So the options have sort of dried up a bit. So I think actually it is a decent option that should be explored. But I also understand that people are pretty scared to participate in the stock market directly. Nearly every Australian is involved in it through their compulsory superannuation, because the superannuation fund invests for them. But as an individual investor, there's not so many of us around. But I've actually enjoyed the experience. Not always. It's been an absolute pain in the ass from time to time. But overall, I would say it's been a positive experience, and I wish I'd done it a lot earlier, to be honest with you. But look, getting the beginning of this story actually goes right back to my childhood, when my father, who was sort of ahead of his time in a way, he actually bought me some shares, and I was only about $70 worth of shares but it was back in the 1960s, so I suppose it actually was worth a fair bit more than it is today. And of course, I got the whole lot in mining shares in a mob called Endurance, which is incredibly ironic given what happened to them, because they had absolutely no endurance after I purchased them. I'd looked at the charts, and they had big bounces in the past, but of course I bought them just before they went into an inevitable nosedive and became totally insolvent. So I was pretty bitter about that, and unfortunately, you know, my father wasn't sort of a person who really shared the experience, as it were, with investing. He didn't give me any great background or advice. He did actually caution me against buying those shares, but that's about it. But I stuck my heels in, and I asked him to buy them, even though there's only a very small amount of money, and he had to cajole his broker to do it, and blew the lot. So what the consequence of that was for me is that I was scarred for life when it came to shares. I wouldn't touch them after that. After a bad experience like that, I thought, well, bugger it, I'll look at alternatives. And like most Australians, I opted to put my wealth into my home, and that worked fine. But it did mean that I've cut a major investment option out of the mix, and I don't think that's such a smart thing to do. So I was a bit traumatised by that experience. So basically, shares were off the agenda as far as I was concerned for decades. In around mid-2000, between 2000 and 2010, and to be honest, I can't remember exactly when I sold my inner suburban house. That was a major turning point for me, in that I all of a sudden had a fair bit of equity, which I hadn't had previously, and it meant that I had the money to buy myself an apartment in the city outright without any loan requirement, and I had some cash left over. I was initially looking at using that cash to buy an even smaller apartment as a second investment property. And I was fairly keen on a property I found which needed needed the plumbing installed, and I knew a plumber who'd do it quite cheaply. And it was actually the real estate agent who put me off, and that was really weird. I quite liked her. I thought she was quite honest, but she'd actually put me off purchasing this other property in the city. And as it turned out, I think that would have been a good investment option. So she didn't really do me a big favour there, but she thought she was doing the right thing. So, and you know, having a real estate agent actually looking out for your interests is not that easy to find. So, you know, I think she's quite a nice person, but it worked against me in this case, I think. But however, it just meant that I had money in the bank for a number of years, and I was just earning the best interest I could get. And I mean, that wasn't too bad considering that compared to some other investments, you're getting a reasonable return. Mind you, compared to the best investment advice I would have given myself if I'd known was to just hold on to my house, because the prices of inner suburban houses in Melbourne just went crazy, and that house probably doubled in price in the next 5 to 8 years. So that was a really bad move, as it turned out. However, it was a lifestyle decision, and I bought the apartment so I could travel regularly overseas, and that did work out. So, you know, it's not always just about money, and it wasn't in this case. So there was a valid reason for me making that decision. However, it wasn't the best thing for me financially, but I still had that money hanging around. And I was happy to just leave it in the bank, collecting interest and what have you, as long as it was a reasonable amount above inflation. I thought, well, that's fine. Trouble is, around 2014, things started to get really sick with the interest earned on your savings, to such an extent that I had to look at options. And I decided to bite the bullet and invest in the stock market into dividend-paying stocks, because I had a friend who'd been investing quite successfully in the market for the last decade and had done really well, probably quadrupled his wealthy records. So that sort of return is quite phenomenal. So you can't possibly knock that. And he just basically works on the presumption that if the returns are that good on, say, a blue chip stock, that they're just, in some cases, paying double figure returns, like 10% or something, on dividends on your stock, well, you've got to buy it because it's just undervalued. And he tries to obviously take the emotion out of the decision and make it on a mathematical decision, and that's a sensible way to go. And you can't ignore the figures, especially with a blue chip stock that you know is not going to tank, at least not in the medium to long term. You would think well, long term it could, but not in the medium term anyway. So you know you've got some safety there. So the strategy for him is basically putting all his money into the major blue chips, and that worked very well for him. And he didn't have a particularly wide portfolio, which was apparently a no-no, but again it worked for him. So it's horses for courses. Conventional wisdom doesn't always work. I mean, the last thing you want to do is listen to investment advisors on the media and the radio or TV. I mean, the obvious question to ask there is, if they're such great investors, why the hell are they sharing this valuable knowledge with people they don't know? They would be just making money themselves if they really had the formula right. They wouldn't be bloody telling anybody else about their secrets. So, but this my friend, of course, isn't in the media. He's just a personal investor. He's quite happy to help out anybody who wants some advice on investing. So I thought, well, look, it's good to know someone like that. So it took a bit of the fear out of the equation for me, and I started to dabble into buying shares. The first 2 lots of shares I bought were in relatively small lots of about 4,000 each. $4,000 lots each, and one was for a mining company, Allied Stock. It actually was, they were providing services, MRM, which was offshore support, with the shipping for oil rigs and the like. So that wasn't strictly a miner, so that's why I decided to put into that one. And that's probably been my most poorly performing stock. That's lost about 2/3 of its value, but that is by far the worst stock that I've bought, and it's also the smallest holding I have. So that's the good news regarding that one. And there's no reason to believe it will not recover in a year or two to something reasonable. I might even, if I got my money back, I'd probably get out. But it's a good lesson. And it didn't cost me my shirt. So that's the main thing. And it's still a viable stock. Unlike a standard mining stock, it does have a future in real assets and potential for earnings. So, but the other one that I got was actually Reject Shop, and I got that through after looking at some advice on the ASX site. There was an advisor there, a little video from an advisor, and that was one of the stocks that he advised. And I was thinking, well, the Reject Shop, even though I've never shopped there, I had to think, well, you know, the economy's not doing brilliantly. We're in a post-mining boom environment, and the economy's slowing. And I'm thinking, what would be recession-proof? And of course, I thought the Reject Shop would be a perfect company to invest in. And so I bought it at a rate where it was paying the same sort of dividend returns as the major supermarkets, Woolworths and Wesfarmers. So that was okay. And so I just sat on that one. And again, I didn't put much into it, probably about 5,000 into that one. So the first two investments were smaller in actual terms, which was probably a good way to start, and that's what Glenn advised me to do. He said do that type of thing, and I took his advice on that, and I also kept the portfolio to a fairly conservative blue chip mix of companies. And that all worked out reasonably okay. And I also took the opportunity to not only invest in these companies long term and take the dividends, but I also decided to trade stocks as well. So a lot of these stocks have had a pattern that formed where they went up and down within a certain range, which seemed to be fairly predictable for a number of months. And I took that opportunity to buy low and sell high, and I did make I made a few profits along the way, so that was good. But I also had a long-term strategy to buy what I regarded as the stocks for the future, solid stocks that would actually give me a continual return in dividends. I basically wanted to get, like at least to say a 5% return on my money if you take the dividends into account on a yearly basis, and that's far exceeding what you would get from, say, a bank deposit. So that was my major goal. It wasn't a super ambitious goal, but if I can make high profits out of trading the stocks in the meantime, I'd do that as well. So I did a combination of both, and that seemed to work out fairly well for me. Now, I also purchased banking stock, quite a few ANZ stocks, and because they had an exposure in India, and I've always thought that India could well be the next China. They've got a lot of infrastructure to build. They're behind China, but they should be a boom economy. So I'm thinking they had quite an investment in software development in India, and I thought that's a good sign to see an Asian-focused bank, and I thought they'd be the one to put money into that, and I focused on them, and their stock price didn't seem to be too bad. I also invested in CBA, Commonwealth Bank, and they're fairly expensive, but they're a loved stock. They're regarded very favourably by many investors, and they've given great returns over the years. I remember actually talking to a friend years ago. She had a fair bit of spare cash, and she'd invested in blue chips like Telstra and Commonwealth Bank, and I sort of poo-pooed and said, well, why don't you get something more exciting? Why something that's going to pay more? As it turned out, Commonwealth Bank was an excellent choice to invest in. They've been giving great returns to their stockholders over the years. So she was right and I was wrong. So I freely admit that my brilliant idea of, say, going into high-tech stocks as opposed to just doing boring old banking stocks, well, it doesn't always work out. It's difficult to pick, and I was wrong on that occasion, and everyone's going to make mistakes, and you've got to accept that as part of the deal too. The other stocks that I invested in, I bought Cochlear shares, again a high-tech company, and CSL, Commonwealth Serum Laboratory shares, again another rarity in the Australian stock market of being a high-tech company, both medically based and with plenty of growth potential and quite healthy companies. I bought them to trade basically, and I traded and made profits out of both of those stocks. Cochlear drove me crazy because it just went, as soon as I bought them, of course, then they just stagnate and the price would not move, and I had to hold them for months, and that's not what you really want to do with a trading stock. You want to, ideally, you want to buy them low and hope their price goes up in the next few days and sell them within the same week. And all you've got to worry about then is your brokerage fees, and then after that you've got pure profits, and you've got your money back to invest elsewhere. But unfortunately for me, Cochlear wasn't following that pattern perfectly. And the last time I bought them, I had to hold them for months before they recovered their price and I could sell them. So that was not good. But that's something about the stock market you've got to cop. It can be incredibly unpredictable because it's mass psychology, and you've got to have a bit of luck. You've got to have a bit of guile, and what I've learnt is that you want to basically spread your investments around. That's a lesson that I've learnt the hard way. And the reason I say that specifically is because I bought far too many Woolworths shares. And let's use the colloquialism, the arse fell out of Woolworths quite some time ago, last year, and I basically had a dog of a stock. I mean, I don't know how I got so overexposed in that particular stock,